It's generally believed in investing that to get higher returns, you need to take greater risks. But is that always true? My guest says not always. For more on this, Jean Masson, he's Managing Director and Lead in Quantitative Research and Development in Low-Volatility Equity Funds at TD Asset Management. That is a good title, Jean. That's a long title. So thanks so much for coming in. I want to start off with just, I think, the premise that, it's accepted that riskier assets like equities would give higher returns than less risky assets like bonds. So just, is that true?
That's certainly true in history.
Yeah.
So it might not be true every day, but it's true over time.
Yeah.
Yes.
Okay, but it's not true though in terms of in terms of equities and bonds. But if you take a look at equities, that's where the interesting conversation comes in.
Indeed. So if you limit your analysis to just equities, then let's say if you look at the S&P 500, you won't see over long periods of time riskier equities, more cyclical equities outperforming defensive equities like utilities or something like this.
Let's take a look. We've got a chart here, I think, where you've taken a look, I think, at 500 stocks in the S&P 500, and you've divided them into 5 groups based on volatility. Yep. Let's bring that up. And what are we seeing in this? What is this showing us?
So horizontal axis is risk. So to the right are riskier stocks, IT, mining, biotech. To the left, defensive stocks, utilities, railroads, food, that kind of thing. And what we see, and the vertical axis are annualized returns from 78 to today, basically. Yeah. And what we see is, if anything, it's flat and kind of gently falling to the right, as opposed to rising.
Yeah.
Right?
Because we want it to be high, but you want the return to be there, but you don't want that volatility.
Exactly. So you don't like volatile stocks or riskier stocks, and you like returns. And what you've seen in history is basically defensive stocks doing just as well as aggressive stocks.
Now, how long has that pattern been in place? I mean, how long have you been seeing it?
As far as we can see in history.
Really?
So basically, you can, for U.S. equities, people go back to the 1920s.
Yeah.
Basically looks similar to what we just saw.
Is there a caveat to this? I mean, in terms of you're looking, I'm assuming at, and we talked about this, longer periods of time.
Yeah.
There's sometimes there can be some dislocation in shorter periods of time.
So think of a full business cycle.
Yeah.
Over short periods, especially when the markets deliver very generous returns, we do see riskier stocks actually delivering better returns. And then the opposite when things are bad. Mm-hmm. So, say markets drop by enough that you notice. So on this graph, for example, you see on the left-hand side, it's roughly 20% of months. These are average monthly returns on these same 5 portfolios sorted by volatilities, all S&P 500 names. Mm-hmm. And what you see is a positive relationship between risk and return when things are great. And this is when the S&P delivers more than 4% in a month. So, you annualize this is 48% a year or more. This is great. And then when the flip side is when equity markets are dropping, riskier stocks lead the market down or drag the market down. But most of the time, we're on the right-hand side.
Yeah.
3/4 of the time, we're on the right-hand side. Markets are up a little, down a little, and people don't pay attention. They wonder whether the Leafs will make the playoffs or it's going to shine or rain or something like this. But if you paid attention, you'd see no relationship between risk and return.
I think that's so interesting, and we'll get a bit more. You've got some great analogy, I know, on this in terms of, for people who have a really long time horizon, why would you take these risks, right?
Exactly. So, one way to think about this is some of the risks in equities are compensated.
Right.
And some are not. And these capitalization weighted indices, the way that these indices are constructed is by size of companies roughly.
Not by volatility.
Not by volatility.
Yeah.
So basically, they contain some of this non-compensated risk.
You've got some examples, and we don't need to go through them all, but we'll bring up the chart of low volatility equities. And these are ones I'm assuming over time that have demonstrated they get adequate returns, but they don't have the bouncing that we've seen. Just can you give us a sense
some of the current low volatility stocks? Because, you could have a stock that's volatile for some time and then becomes a boring stock later.
And so these are recently less volatile.
Exactly. So
Yeah.
these, for the last 3, 4, 5 years, have been among the least volatile equities in global portfolios. And you have names. Not all of these are like super well-known companies, but
Yeah.
CCOM, for example, is Japanese alarms company. So they have subscriptions. People have alarms for burglars or
Yeah.
monoxide.
But it's a regular
poisoning or
subscription
something.
you're buying.
Exactly,
and-
subscription basis. It's pretty boring company,
Yeah.
but profitable, beautiful returns,
Yeah.
and not particularly sensitive to the state of the economy.
Let me ask you, we've only got about 30 seconds, but when you've been doing this for, I think you were the first one to bring in low-vol solutions about 10 years ago. You've got a suite of low-vol products. What are the key lessons you think there are to learn in terms of either what you've been doing for the past 10 years going ahead or for people listening?
So to me, the key is to stop being so sensitive to being different from the cap-weighted index. There's nothing really special about the cap-weighted index, and if you dissect that index, you'll notice, some interesting companies, some less interesting companies, and for people who are less allergic to being different, there are beautiful returns with low volatility and, a nice investor experience, basically.
Jean, thanks so much for coming in.
Thank you for having me.